Hello, Sector Watchers. Welcome to the 17th episode of Sector Spotlight on Tuesday, the 4th of February, 2020. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and/or rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show. And with me are Rachel and Zach for production and technology. If you want to participate, the chat box is open during the show, and we will monitor what's coming in. However, email still seems to be the preferred way of communicating, and that is totally fine. Just don't be shy. Ladies and gentlemen, this is Sector Spotlight. And welcome, everybody. So if you want to connect with us, then here are the handles where you can reach me. Please reach out if you've got anything to say or any comments. I'll answer anything that comes in. Honestly, I'll do. Agenda for today, it's the first show of the month of February. So that means that we have some fresh monthly charts to look at. So I'll combine them with our usual asset class and sector overview. Then while I was preparing my show, I came across a chart, which is, I think, a special chart, and I'd like to share that one with you. We'll have the usual break. At least one question came in via the mail, and I'm going to answer that in the mailbag, and then we are back to a new pair trade idea for this week. So please stay tuned. Let's bring up some charts, and this is the performance for the asset classes during the month of January. We had 22 trading days, and that gives us 31st of December to the 31st of January. As you can see, not the best month around, especially not for commodities, minus 8.5%. They really got trashed. Performance-wise, the fixed income collective here on the left-hand side with government bonds, 7 to 10 year leading the pack with almost 3.5% performance. And we have the S&P 500, well, let's say unchanged, minus 0.04%. We bring that to a relative, then this is the image. Here is the Vanguard Balanced Index Fund, and the S&P underperformed 0.85% to that Vanguard Balanced Index Fund. If we look at the RRG that comes with that set of asset classes, we see that the S&P is rolling over. We've seen that for a couple of weeks already. It's still in the leading quadrant, so no matter what happens, this is still the strongest asset class for the time being, although it is losing somewhat of its momentum. We've got the commodities still doing really, really bad. I mean, this is you probably can't get worse than this. And we've got government bonds, and we've got high yield, and we've got corporate bonds all picking up some momentum. So they are improving while stocks are deteriorating. But the trend is still in favor of stocks over bonds. We're going to look at how that looks on longer term, shorter term images in a little bit. Let's quickly move to the sectors because we've established what is happening on the asset class level. So if we go to the performance chart for the various sectors, and I need to bring this to 22 trading days and then tick one back, so we got the full month again. And we're going to bring in here the sector ETFs. Let's give it a little bit more space. And we see that utilities and technology were really, really doing very well during the month of January. This is already relative to S&P 500. So this is all the good stuff. This has been outperforming. And on the weaker side, we have discretionary industrials almost in line with the index, and then the real weakness was found in energy. Not surprising, that's been going on for a couple of months already. And they're now joined by materials, healthcare, and to a lesser extent, financials. So there's a little bit of a mixed picture here because utilities, real estate are clearly defensive sectors, staples as well, but they're already not outperforming that much. But also healthcare normally is judged to be a defensive sector, and that's now really one of the weaker ones. And technologies, well, I mean, in my textbook, it usually isn't a defensive sector, but it appears to be doing very, very well in this market environment. So let's see how all this relates to the monthly images that we can bring on. Let me give you the RRG of asset classes real quick, and then we're going to move to the monthly asset class charts. And I'll do this relatively quickly, so not spend too much time on that. So here is SPY. This is the chart of SPY that I am watching. It's the uptrend that emerged out of that 2009 low. We have now 1, 2, 3, 4, 5, 6, 7 touch points. So this solid trend line is becoming more and more important. And then I've got some dashed lines, which I am trying to keep parallel to that support line. We've got the one here in the middle that has a number of touch points. There's one big, it's hovering around this resistance area. And then we broke out, rallied, and then the old resistance functioned as support 2 times before we broke down. And look at this situation, because I'm going to go back to this situation a little bit later on. We got back above it. This line started to work as support again, held it a few times. And now we are actually breaking above this rising resistance line. All in all, that is still bullish. I mean, there's not much you can say, but that is still a bullish thing. And we're holding up there. And even though that last bit here, that is the month so far, we're still above that former resistance line that should now act as support. And I want to go a little bit deeper into that. This is that same chart, but now zoomed in. And the reason I've put these little ovals in there is because in my experience, and I've not found any, let's say, written material or other people observing it, but what I've seen happening a lot is that when you have situations like this, where there is an uptrend, a market breaks out on the upside, out of that uptrend, that's super bullish. When it then drops back into that old channel, the odds seem to be very high that it's going to do for a test of that channel. So what we saw here is held, it breaks, and then it drops to that rising support line, so to this level. And if that is going to happen now, mind you, it hasn't happened yet, but if that's going to happen, I am going to watch the areas, first of all, around 300. There's a cluster of support levels there for the S&P 500, or for SPY in this case. And then if push comes to shove and things get really bad, then it'll be somewhere, well, by the time that happens, this is probably around 270. So that's a relatively big drop. But what the point that I'm trying to make here is that this market can handle a relatively big drop in prices without breaking the uptrend that started in 2009, or maybe if you want to argue, it started in 2009, it stopped here, and then it started again in 2017. I mean, that's a debatable issue, but anyway, I don't think that that uptrend is going to break very fast, and there is enough space, there is enough downside for this market to go into a correction without breaking that longer-term uptrend. Let's quickly move on to bonds. I'd like to look at the unadjusted prices for bonds because this is where people have traded, and then you'll see that 114 level coming up as a serious resistance level that has not been broken yet. If that breaks, that'll definitely be a good push for bonds to move higher. And the same thing is happening with corporate bonds. We broke out of that range. We're still holding there, so that's still in a good uptrend. And we'll have somewhat similar with high yield. That's still going sideways. Let's not spend too much time there. And then the real estate, there's a lot of dividend in that. This is a total return chart. That still looks very good. If we go to the unadjusted chart, you'll see that the area around 95, are we breaking it or are we not breaking it? This is sort of crossroads. If we break above this 94.5, 95 area comfortably and we stay there, that's very bullish for real estate. If we start building a peak here, then I think there is a big chance that we drop back and we go into that trading range. Levels to watch, probably around 85, maybe around 70. And then here is the commodity chart. Those of you who've seen my contribution to the 2020 Outlook, I recorded that on the 23rd of December. So that was right here. And I thought, well, you know what? Commodities could be in for a surprise if this holds up. We could move all the way up to that 25 area. And I think that's a pretty good example why you shouldn't be doing long-term outlooks as technical analyst, especially if you know that's going to be aired in a month's time, because it sort of went completely the other way, and we're now pushing against that support level again. If that breaks, ladies and gentlemen, I don't know what's going to happen with commodities, but it won't be good. So that's for the asset classes. Let's quickly move to the monthly stuff that we have for the stocks, for the asset classes that we have in stocks. Where are my monthly charts? ETFs monthly. Let's use this one here. We did SPY already. And now we have communication services. Let's put that in sync here. Where is my materials? So here's materials. Materials. Lagging quadrant, moving further down. It's one of the few sectors that did not break to an all-time high. So that is completely understandable why this one is in the lagging quadrant. For the time being, there is still a lot of overhead resistance, so I expect materials to continue their underperforming trend versus SPY. We look at communication services. It's improving, but it's already rolling over. And you see that in candle terms, this was a pretty bad month. The month of January, we opened and closed almost at the same level. And we had a pretty higher high. So that's very indecisive. There seems to be a turnaround during the month. So I'm not so sure about communication services. And you see that it's already rolling over inside the improving quadrant. Energy seems to be breaking out to the downside, and that's confirming or maybe even reaffirming the weakness that we see in this sector on the RRG, while it just rotated back into lagging and going further down. This could be some sort of a triangle-like consolidation that we're about to break right now. We're not there yet, but it's not a very strong chart. Then we have financials. Deteriorating right now. The chart looks pretty good, but it's not going up fast enough. It's losing relative momentum. That's why it's in the weakening quadrant. And it looks to be underway for a move into the lagging quadrant. So we're going to keep an eye on the financial sector for the time being. And the same is happening with industrials. That chart doesn't look too bad. That breakout is pretty good. It's holding up. But on the RRG, it's well inside lagging and pushing deeper into it. So this is very likely going to be another underperforming sector in the months, weeks coming. Technology is the star of the moment still, I should say. Stellar trend, another good month, another good start of this month, and continuing further into the leading quadrant. So that is really still going strong. I don't know where it's going to stop, but I mean, there are no signs that it's going to stop. It's all still looking very, very good. Staples, supposedly a defensive sector. Trend still good. This one is still good, but it's inside lagging, coming up. So it's picking up a little bit, but still inside lagging, still moving left on the RS ratio scale, which means that we're still losing relative strength despite the increase in momentum. Very, very early, but it's one of the sectors that if things go bad and go sour, this is one of the sectors where you can definitely hide. The same goes for real estate, although on the RRG, this is an almost vertical move. It's only momentum driven. It's not yet picking up in terms of relative strength. So that's the stuff that you really need to see before this one will start to become an outperforming trend versus SPY. We really need to see a pickup in RS ratio there. Speed it up, and then we got utilities, and I said technology was the star. Well, in performance terms, utilities is the star, and you see a very nice long tail, which means power for utilities, already pushing into improving. And look at this acceleration in price. So this is really a defensive move. and it's improving very rapidly. So please keep an eye on that one. Together with staples, definitely one of the sectors that you want to hold a position in when things start to turn the wrong way. Maybe build it up a little bit right now just to be sure. And then finally, we have healthcare, traditionally a defensive sector, but it lost a lot of momentum over the last couple of weeks. The trend is still good. You see the break out of this consolidation is still holding up, but it's not keeping up with the speed of the S&P 500. And the same goes for discretionary. This is picking up. It's picking up speed, goes against the healthcare sector. We pushed that as a pair trade in the previous show, and you see that that thing is now continuing. That move, this is what happened since last week, and this is what happened in healthcare last week. So that trade, that idea, being on the long end for discretionary and the short end for healthcare, is working out for the time being. I am going to come back to that special chart after the break and the mailbag if there is time. Otherwise, I'm going to write it up. We're going to go quickly to a break right now, and we'll be back in 20, 30 seconds. Stay tuned. We'll be back in a minute. And we're back. And Rachel, I think there is one question that came on over the chat. Do you mind reading that out to me so we can have a quick look at that?
Of course. This question comes from Dan. What, in your opinion, is the best way to use the right-hand column on a percent change on RRG?
All right, so that column with the percentages is showing the percentage gain for each sector over the length of the tail. So if you let me bring up one chart here. I'm gonna bring that big here. You see that healthcare is 0.7% over 5 weeks. So in this 5-week period, healthcare gained 0.7%. Utilities over the same period gained 7.9%. Now watch if I shorten that period to, let's say, 3 weeks. You see that utilities is now 3.4%, whereas healthcare minus 2.4. There is no best or right or wrong way to use this column. I think it's just very helpful to see whether those trends are actually materializing. So if you bring that to, I think I usually do it like 5 weeks, 6, 10 weeks, doesn't really matter. You can see, you can check whether they are in green, red, or orange. And you can see here that when this is mixed, that usually means that there is some sort of a change going on. Because you see that we've got utilities, that's the highest one, it's in improving. We've got technology, which is still going strong, inside leading. But we've got 2 inside lagging that are rapidly improving. So to me, that means that I need to at least pay attention to this. And you can just play around with this. It's just helpful. There's no right or wrong way or intention. It just gives you a little bit of flavor because you don't have a price scale on an RRG. It gives you a little bit of flavor and an idea what has happened performance-wise. So that's why that column is there, actually. Let's quickly move on to the question that came in via the mail. And it's a rather long one. And someone wrote me an email following up on the previous show. And he or she said, on your sharp chart, you use the RS price ratio and the RRG JDK RS ratio. Why? And can you spend a little time explaining the difference between the two? And then more specifically, this person is referring to the XLK chart that I was showing in that show. And the observation is that the RS price ratio is diverging from the JDK RS ratio. And that's correct, because they are not the same thing. They're doing two different things. And this is the chart that we're talking about. And this is the chart that I showed in that 16th, that was last week's show. The blue one here is the ratio chart. That's just the price ratio between technology and SPY. The lower chart are what I call the RRG lines, which is the RS ratio and the RS momentum lines. Now, the big difference between the two and what enables us to create RRGs, and what is one of the very powerful features of RRGs in these lines, is that they are comparable across the universe. This ratio line is super helpful. It's super interesting. It gives us a lot of information. But the numerical value of that line holds no information, because it's completely dependent on the price level of the sector. So we can have a situation where technology, which is trading at 96 and has a price ratio of 0.3 and is moving up, compared to, I don't know on top of my head, but if there is a sector that is trading at 300 and the ratio chart is moving down, but because of the high value of that price, the thing is trading around 1.5, then the 1.5 is not necessarily better than the 0.3. So we actually need to look at the trend, and we cannot look at the numerical value. That's why these ratio charts are, I always call them single security charts, or they only show a one-on-one relationship, and they're super helpful for that one-on-one relationship, but not when you want to do a comparison across the universe. And that's where RS ratio and RS momentum come in. The RS ratio is a measure of trend of that ratio chart, and it does it in a way that we can actually compare that number across all the other sectors in the universe. So that enables us to actually do a ranking of a universe based on, say, RS ratio. High values are good, low values are bad. And what the green line does, it's sort of a early warning system to warn us when something happens with that trend. By the way, above 100 is an uptrend, below 100 is a downtrend. And you can see that when the red line pushed above 100 somewhere in the beginning of 2017, this RS ratio line sort of captured the whole uptrend in that relative strength versus SPY until November 2018. And then it started picking it up again in April 2019, and we're still there. And you see that these little humps and bumps are picked up by that momentum line, and that's causing the rotation from leading, because here when they are both above 100, the sector is inside the leading quadrant. Then when the green line, the momentum line, drops below 100, it means that on the RRG, the sector is now inside weakening. And then when it goes above 100 again, it's rotating from weakening back into leading. So that uptrend is still there. It's just showing that we have a very strong relative trend at hand. And that happened again here in 2019 in the summer. And very recently, at the end of the year, somewhere in November, we pushed above it again. And since then, we're back into the leading quadrant. So we have leading, weakening, and then we pick up again, and we're in full swing inside the leading quadrant. So that is where that difference is coming from. So the raw RS, raw relative strength, raw ratio line, super helpful in a one-on-one comparison, but cannot be used against multiple securities. The RRG lines will pick up the trends in that ratio for multiple securities across the universe, and that enables us to actually draw and render an RRG because they're all comparable. We got some 5 minutes left. I'm going to go with the pair trade idea first, and then see if we have some time for my special chart. And the pair trade idea for this week is coming from commodities. I thought, commodities super bad. asset class, but maybe we have some opportunities in commodities. And the one that I was looking at, I actually need to put you there and bring a chart here. That's fine. And you know that commodities are actually a predefined group. They're all the way down. They are representing a number of Bloomberg commodity ETFs. That's the best data sets that we can have. And the two rotations that I was actually looking at were, where's my node? The industrials metals. That is actually not very good. It's inside lagging, and it's not doing a good thing. And the ticker symbol for that is JJMTF. And I need to bring that to TJP. And then you'll see that this is actually breaking down on price with RRG-Lines and relative strength weakening. So this is my leg that I don't want to be in, my short side. And then I was looking at the precious metals. That looks like a very nice rotation, and it is. And we're going to put them against each other. But the problem is that if you put in JJPFF, you get a chart like this. And that, I am not really happy when I see charts like that, because the underlying group should be very liquid, tradable. But a chart like this usually means that the instrument is not very tradable. But this is precious metals. And I know that a lot of people are looking at gold. So what I did is I added gold ETF to this RRG, which means this. And this looks very nice. And if we then look at GLD, then we see a nice breakout still holding up there, and the RRG lines turning up. So my pair trade idea for this week is actually to be long precious metals, preferably gold, and there is a good ETF for that, that's GLD. And on the short side, we'll have the industrial metals. Oh, by the way, I just see a typo. These prices are not good. We're going to change that in the replay for the show. We're going to put in a right slide with the correct prices. But that is the idea, that we're going to have gold outperforming the industrial metals. Now, I'm quickly going to go back to my special chart. And the first thing that, because I was preparing for my show on asset classes, and I was playing around with charts, and this one came up. And I thought, is this bullish or bearish? My take, we don't have a lot of time left, is that it is bullish. And it is actually the ratio of SPY versus TLT, so stocks versus bonds on a quarterly basis. So this is a super long-term trend. And if we do that on a little bit shorter term basis, so we do SPY versus TLT, because this is where I started playing around, then you see that the ratio is sort of rolling over in the shorter term. This is the daily, so we're rolling over short term. But I thought, what is about the long-term picture here? And then I saw this one, and I think, hey, this is still very long-term bullish for stocks over bonds. So the long-term trend is still preferring stocks over bonds. The short-term is still bonds over stocks. And that comes to the conclusion. So this was the 17th episode of Sector Spotlight, and I'd like to thank you for watching. Please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday, 10:30 to 11 EM Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you receive a nudge every time a new article is posted. Thank you, and I'll see you all next week.